When the stock market crash, what to do? The market may be about to reach historic highs. But the next moment, it could drop. Markets have been extremely volatile during 2022 due to worries about increasing inflation and interest rates. In June, markets fell further as inflation data reached a 40-year high. Following a brief comparable decline on May 20th, the S&P 500 entered a bear market once more on June 13th. Although the duration of crashes, stock market corrections, and bear markets can be estimated from historical data, no one is given a calendar notice indicating the timing, nature, and anticipated size of upcoming declines. A stock market crash, what is it? The most recent stock market crash occurred in early 2020, at the start of the COVID-19 pandemic. Trading may be suspended for 15 minutes if the S&P 500 falls 7% in one day. This is an extremely awful day for Wall Street and has only happened a few times in the history of the market. A crash is characterized by a rapid, dramatic decline in stock values that typically occurs after an upward trend, or bull market, in the stock market. Even though the stock market has its ups and downs, stock market crashes are not all that common. Here is a list of stock market crashes throughout history. 1929, the Great Depression began when the stock market crashed as a result of a faltering economy and investor panic. More than 80% below its peak values, the market hit its bottom in 1932, and it took more than 20 years to recover. 1987, in response to a market collapse, investor panic, and early automated trading gone wrong on Black Monday, the market fell by 25%. The market did, however, bounce back within 2 years, and the Securities and Exchange Commission put in place circuit breakers and trading controls to stop panic sell-offs. 2000, the dot-com bubble burst in March 2000 following a spike in investment and speculation in businesses tied to the internet during the 1990s. After a roughly 50% decline, the S&P 500 took 7 years to recover. 2008, the S&P 500 lost over half of its value as a result of the housing bubble and subprime mortgage crisis, and it took 2 years for it to recover. 2020, in just over a month, the market dropped by over 30% as COVID-19 swept around the world in February 2020. However, the market had already recovered by August 2020, requiring 6 months to do so. In many cases, it is best to ride out the downturns if you have a long investment horizon and are well diversified. Furthermore, by being aware that a crash is a possibility, you can prepare for it and respond carefully. Here is a 5-step strategy for handling a market crisis. 1. Understand what you own and why. A momentary dip shouldn't be used as an excuse to sell an investment out of fear. However, you can discover some compelling arguments to sell if you go back and review your first stock research notes. A comprehensive stock analysis contains a written account of the benefits, drawbacks, and intended use of each investment in your portfolio, as well as the factors that might cause each investment to end up in the out box. Your study serves as a physical reminder of the qualities that make a stock worthwhile to hold, much like a road map for investing. This guide can help you avoid removing a perfectly good long-term investment from your portfolio during a market downturn just because it had a terrible day. On the other hand, it also offers sensible justifications for selling a stock. 2. Put your faith in diversification. When the market falls, your results may differ, and possibly for the better, if you've spread your money across different asset classes such as stocks and bonds. By diversifying, you can prevent your investments, eggs, from becoming overly reliant on one sort of asset basket. Thus, if a particular stock or sector has a bad day, your other investments may help you recover some of your losses. Diversification is already built in if you use a set-it-and-forget-it strategy, such as investing in a target-date retirement fund, which many 401k plans allow you to do, or using a robo-advisor. In this situation, it is advisable to remain calm and believe that your portfolio is prepared to weather the storm. You'll still feel some unpleasant short-term shocks, but you'll be able to prevent losses that your portfolio won't be able to recover from. 3. Prepare to purchase the dip. Market declines can also present a chance to buy. Consider it as purchasing equities at a discount during a market downturn. The key is to be prepared for the decline and ready to spend some money to purchase investments whose prices are falling. Here's how to determine if you're prepared to purchase the dip. You already have a retirement fund set up, an emergency fund, and cash on hand for daily needs. When calamity comes, you've saved up some money so you'll be prepared for a flash sale, and you keep a running list of certain equities you'd like to acquire. Even while you probably won't get the stock at its bottom if you purchase the drop, that's okay. The idea is to seize opportunities when making investments that you believe have strong long-term potential. 4. Obtain a second viewpoint. When the stock market is booming and the value of your portfolio is increasing, investing is satisfying. But when things are difficult, self-doubt and foolish strategies can get entrenched. Even the most self-assured saver investor is susceptible to the dangers of short-term thinking. Stay away from letting self-doubt ruin your financial ambitions. Consider engaging a financial advisor to examine your portfolio and offer an unbiased viewpoint on your financial strategy. Financial planners frequently employ their own financial planner on a personal basis for the same reason, in fact. Knowing you can call someone to help you get through difficult times is an added benefit. 5. Focus on the long term. It can be challenging to watch the value of your portfolio drop while taking no action during a stock market downturn. Watching your portfolio decline in a year when you may have experienced illness, loss, or job loss due to the COVID-19 pandemic can be particularly difficult. After a crash, it's common to feel pessimistic, but if you're investing for the long term, staying put is frequently the smartest move. It's crucial to keep in mind that when you sell investments during a slump, your losses are locked in. 6. Take advantage of every opportunity. It can be painful to see your carefully curated portfolio take some unpleasant dips. However, planning for the future can help alleviate some of the discomfort. Financial planners frequently point out that market declines can be a good time to convert to a Roth IRA. Investors can assess the depreciated assets in their traditional IRA and transfer some of the funds to a Roth IRA. You can happily watch those migrated assets grow tax-free once the market begins to recover. It is important to note, however, that Roth conversions may not be appropriate for everyone. One concern is that they frequently result in additional taxes because the transfer generates ordinary income. Speaking with a tax professional can help you determine whether the move is right for you.